You've seen them, right? Those commercial real estate deals promising incredible, almost unbelievable returns. But what if those returns aren't really coming from the property's performance, but from some, let's say, clever financial footwork? Well, today we're pulling back the curtain on the syndication shell game.
Okay, let's dive into this quote because it gets right to the heart of the matter. This single sentence, it just perfectly captures the challenge. As an investor, your entire return depends on which side of that line your deal falls. So, are you actually betting on a solid asset, or are you just investing in a really, really good-looking spreadsheet?
That is the big question, isn't it? And today, we're going to answer it. We're going to break down the 3 most common plays from the syndicator's playbook for engineering returns, so the next time you see one, you can spot it a mile away.
All right, first up is what the source material for this calls the most dangerous variable in any financial model, and that is the exit capitalization rate, or cap rate for short. It's the single most powerful lever that can create millions of dollars in value pretty much out of thin air. Now, the math looks deceptively simple. You just take the property's annual income, you divide it by this rate, and boom, that's your future sale price. But here's the secret. The lower the cap rate, the higher the valuation. And that, my friends, is where the game begins. So for this example, let's lock in the income at $1 million. The property's performance isn't changing one bit. Now let's just see what happens when we tweak that one little number in the denominator, that exit cap rate.
An aggressive sponsor might project selling at a 5.5% cap rate. But a more conservative model would say, hey, after 5 years, the building's older, the market might be a little cooler, let's use a 6% rate. It's only a 0.5% difference. I mean, what could that possibly be worth?
Well, here's the power of that tiny lever. That little 0.5% assumption changes the projected sale price of the exact same property by over $1.5 million. It's kind of nuts.
And here's the takeaway. A single assumption, buried deep in some spreadsheet, can manufacture enough value to wipe out nearly a third of your entire projected profit if reality doesn't cooperate.
This analogy from the source material just says it all, doesn't it? The plan looks incredible, but it has absolutely zero margin for error. The second that tailwind disappears, you are definitely not getting where you thought you were going.
Okay, so if you can't engineer the value, you can always engineer the time. Our second play targets a metric that investors absolutely love, the internal rate of return, or IRR.
The keywords to focus on here are time-weighted. See, IRR doesn't just care about how much money you make, it cares about how fast you make it. So the shorter the time your money is in the deal, the higher the IRR will be.
So here's the trick. Instead of taking your investment money on day one, the sponsor uses a short-term loan. It's called a subscription line. They don't actually call your capital for a few months. This simple delay means the clock on your investment starts ticking later.
And this timeline just makes it crystal clear. Both deals last 5 years, they both produce the exact same profit. But in deal B, because your money officially went in 4 months later, the IRR calculation thinks you got the same return in less time, which artificially inflates the number.
So what does this actually mean for you? Well, you don't make a single dollar more. Your total profit is identical. The only thing that changes is the IRR, which is basically a vanity metric. It looks great in a marketing deck, but it doesn't put any more cash in your pocket.
So we've seen how value and time can be manipulated. The third play is even simpler. You just pretend the costs are going to be lower than they really are. Let's uncover some of these hidden leaks.
This table shows how these small individual assumptions can really start to add up. You're projecting a 3% management fee when the market rate is closer to 5%? Check. You're ignoring the need to set aside money for future roof repairs? Check. Each of these optimistic projections makes the deal look better on paper today, but they're just hiding liabilities that will definitely show up tomorrow.
But the biggest offender of them all is often the property tax. You see, a sale resets the property's value for tax purposes. So if the financial model only shows a tiny 2 to 3% tax increase in year one, that is a massive red flag. That tax bill could be about to jump dramatically, eating up all of your cash flow.
And this treadmill analogy just perfectly captures the danger. The pro forma looks like a world-class athlete, but the underlying asset, it hasn't actually improved its performance at all. So when it's time for the real race, actually selling the property, reality is going to hit, and it's going to hit hard.
Okay, now that we know the plays, let's talk about defense. You don't need a PhD in finance to protect yourself. Honestly, you just need to know the right questions to ask.
So here it is, your 3-question stress test. First, ask the sponsor to run the numbers with a slightly higher exit cap rate. Second, scour the expense sheet for that big property tax jump after the sale. And third, compare their rent growth assumptions to what's actually happened in that market historically.
Ultimately, it all comes down to this. A truly good deal has a margin of safety. It should still work even if things don't go perfectly. But if one tiny tweak to one assumption causes the whole thing to fall apart, then you know the returns were just a fantasy manufactured in a spreadsheet.
And that's the question I want to leave you with. By understanding these games, you can now look beyond the flashy IRR and ask the tough questions that separate a solid, durable investment from a fragile financial illusion. Thanks for digging into this with me.